Gentlemen, just taking a look at what we've been watching with the markets today. Obviously, things are under a little bit of pressure today, but we have been looking at much higher markets if you go back to the Christmas Eve low and the concern about what the Fed might or might not be doing. Since that time, the Fed has sounded much more dovish. And I just wonder if you could talk a little bit about your own take on the markets. And Bill, again, I've spoken with Warren and Charlie earlier about this a little bit. So how about your take? When you hear that the Federal Reserve is probably not going to be raising interest rates anytime soon, how does that change your outlook on equities or equities versus treasuries?
Well, the interest rate is like gravity, and all these valuations are dramatically affected by it. At the start of the year, people didn't think the 10-year bond would be where it is today, and that's provided a lot of lift. So it was a big first quarter for U.S. equities. We still, if you look forward, are at these very high valuation levels. And so it's hard to see that the market will be gaining a lot over the next few years. I think people should have fairly modest expectations on what their portfolios will make in the years in front of us. Have you changed your positions in your own portfolio as a result of this? Have you done any major? No, it's a very equity-oriented portfolio. It's overweight in the U.S., even though it's got a lot of overseas exposure. It's a bullish portfolio that the American economy over time will do well. Fortunately, even if we have a few years here where markets are doing that well, we've been lucky. We have a cushion. The foundation continue to spend generously. Mm-hmm. But I'm amazed at how high the valuations are if you look broadly.
Charlie, do you think that?
Well, sure. I think that if you drive interest rates down to zero and all the countries print money like crazy, it's lifted the asset boat for everybody. And I think it really is. So they didn't have anything else to do in the Great Recession. And so they took the only weapon they had and used it aggressively. I don't think we should quarrel with that. It did cause the people who were already rich to get richer. But that wasn't done on purpose or anything like that. And I think that will correct automatically.
Do you think we should still be using that weapon aggressively, which is what President Trump would like to see happen? He wants them to cut interest rates again, I think he said by 1%, and also push up quantitative easing once again. I
am so afraid of a democracy getting the idea that you can just print money to solve all problems. And eventually, I know that will fail. Singapore, which has a marvelous economy, has zero debt. If I were running the world, I would like the United States to be in that position. That is not the typical. That's nobody's position. All these politicians in Europe and America have learned to print money.
And if we keep at these extraordinary measures for the Fed, I guess not just the Fed here, but central banks around the globe.
Yes, but who knows when money printing runs out of control? And at the end, if you print too much, you end up in something like Venezuela.
You're not suggesting that happens anytime soon?
No, but I don't like the idea. And both parties, you have politicians say, what we've learned is we can print all the money we want.
Right.
We don't have to raise taxes, we just print.
Warren, you share those concerns?
Yeah, I probably could not have conceived of a world as recently as 10 years ago. I would not have conceived of a world where you would have full employment, 5% budget deficits, with actually the probability of those rising from that level, and at the same time have the long bond at 3%. I would have said that couldn't happen. And then people now, you have this modern monetary theory, which there's no question you should borrow, any country should borrow money in its own currency. I mean, that is not like it's some great discovery or something's been announced, but
no, it can be overdone.
Yeah, and that's the point. I mean, that hasn't solved anything. Just to say, well, it's much safer to borrow money in your own currency, but the convergence of these factors would have seemed impossible to me, and generally, if I feel something is impossible, it's going to change over time. I don't know in what way, but I don't think we can continue to have these variables in this relationship. Now, if we can, then stocks are ridiculously cheap.
The one thing I will say, though, is this is a conversation I feel like we've had for at least 4 or 5 years.
Right.
Where you're watching and continuing to wait for these interest rates, the yields to rise. We're still sitting at 2.5% on the 10-year, which is shocking.
Yeah, and we're sitting with very, very little inflation with a Federal Reserve that put a target for 2% on it not that long ago. And it looks like nirvana. It looks like we found the promised land where we just essentially money doesn't cost anything, and you can print lots of money and have full employment and no inflation. And I would have thought that something would have happened before now. I don't know what would have happened, but I wouldn't think you could have these things at these levels, the long-term rates, inflation rates, budget deficits, and have that be a stable situation for a long period of time. And I still believe that, but so far I'm wrong.
So in the meantime, you haven't really changed how you...
I think stocks are ridiculously cheap compared, if you believe that you're going to have the 3% interest, 30-year bonds makes sense.
That's a big if, though.
Well, that's what makes going to work interesting.
Well, this threesome is comfortable if everything goes down by 90%. So we're not a fair cross-section.
I'm sorry, Charlie, what was that?
I say this threesome is comfortable if everything goes down by 90%. It doesn't really hurt us.
Equities know the rest.
Yeah, but we wouldn't want that kind of a world happening to everybody else.